Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Tidewater Inc. Annual Report. Tidewater Inc. provides a wide range of businesses and services to the offshore energy industry through its fleet of vessels worldwide. The company operates in 5 segments: Americas, Asia-Pacific, Middle East, Europe/Mediterranean, and West Africa. The company offers various services including towing and anchor handling for mobile offshore drilling units, transportation of supplies and personnel necessary for drilling, workover and production operations, field abandonment, dismantlement, and restoration activities. Tidewater Inc. also provides offshore construction, seismic and subsea support, pipe laying, cable laying, and geotechnical survey support. In addition to these services, the company offers specialized services such as wind farm development and maintenance activities, transportation of supplies and personnel necessary for drilling, workover, and production operations. Its vessels consist of anchor handling towing supply vessels, platform supply vessels, and other specialty vessels that cater to various needs of the offshore energy industry. The company serves a diverse range of clients including integrated and independent oil and gas exploration, development, and production companies, mid-sized and smaller independent exploration and production companies, foreign government-owned or government-controlled organizations, offshore drilling contractors, and other companies providing services to the offshore energy industry. The stock price of Tidewater Inc. (TDW) has skyrocketed by over 86% in the past year due to a combination of strong financial performance and strategic business moves. One key driver behind this surge is the company's impressive fourth quarter and full year 2025 earnings, which exceeded Wall Street expectations, with EPS soaring to $4.41 from $0.70 a year ago. Tidewater's acquisition of Wilson Sons Ultratug Offshore for $500 million has also contributed significantly to its stock price increase. This deal adds 22 platform supply vessels to Tidewater's fleet, primarily in Brazil, enhancing its operational capacity and solidifying its presence in the offshore support vessel sector. The acquisition is expected to be accretive to both EPS and cash flow in 2026 and 2027. In addition to these developments, Tidewater has raised its full-year 2026 revenue guidance to $1.43 billion to $1.48 billion, signaling strong confidence in its medium-term growth trajectory. Favorable market conditions in the energy sector, including tight vessel supply and increasing offshore drilling activity, have also contributed to the stock's surge. Furthermore, Tidewater has seen increased institutional investor interest, with significant big money inflows indicating high confidence from large investors. The company's improved operational metrics, including higher vessel utilization rates and increased average day rates across its fleet, have also boosted investor confidence in the company's future prospects. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in the oil and gas industry can be categorized into 2 main groups: market-related factors and operational factors. Market-related factors include fluctuations in oil and gas prices, capital spending by customers, vessel time charter contracts, offshore exploration and production activity, customer demand for offshore projects. Volatility in oil and gas prices, downturns in the industry, sustained market uncertainty, changes in customer preferences and technological advancements, and limitations on access to credit and debt markets. These factors are directly linked to the overall demand for services and the ability of customers to invest in new projects. Operational factors, on the other hand, include vessel capabilities and availability, maritime regulations, compliance with labor laws, marine losses, business interruption due to political action or inaction, climate change and related regulations, severe weather events, energy transition, and mergers and acquisitions. These factors can impact the company's ability to deliver services efficiently and effectively. In summary, market-related factors are the primary drivers of revenue growth or decline, while operational factors play a secondary role. Understanding these drivers is crucial for companies operating in the oil and gas industry to make informed decisions about investments, resource allocation, and risk management. Net income experienced fluctuations between 2024 and 2025. Initially, it increased to $333.5 million from an unspecified amount in 2024. However, this growth was short-lived, as net income decreased due to impairment charges and vessel dispositions on page 60. The decrease in net income can be attributed to various factors such as changes in market conditions, vessel sales, and estimates of fair value. On the other hand, a specific reason for the decline is mentioned on page 85, where it states that net income decreased by an unspecified amount from 2024 to 2025. Profit margins were also affected during this period. A significant change occurred due to the declining oil and gas market, resulting in a higher effective tax rate of approximately 30%, previously averaging around 20–25%. This increase in tax rates had a direct impact on profit margins. The lack of clear information on the change in profit margins for other years makes it challenging to draw a comprehensive conclusion. Nonetheless, it is evident that both net income and profit margins experienced changes between 2024 and 2025 due to various market and economic factors. The company's financial performance indicates a strong ability to generate cash from its operations. The net income for the year was $333.5 million, which is a significant amount. However, what's more impressive is the company's operating cash flow, which stood at $379.1 million in 2025 and $282.5 million in 2024. This positive trend suggests that the company is efficiently managing its resources and generating sufficient cash to cover its expenses. The data confirms that the company has been consistently producing positive operating cash flow over the past 2 years. The net cash provided by operating activities was substantial, indicating a strong ability to generate cash from its core business operations. This is a positive sign for investors and stakeholders, as it suggests that the company has a stable financial foundation and can continue to invest in growth initiatives without straining its resources. The Wilson Company's debt level and interest expenses have shown some fluctuations over the past few years. In 2023, a significant milestone was reached with the extinguishment of a $1 billion senior secured term loan on June 30th. However, this move was followed by the entry into a new revolving credit facility in July 2025, indicating that debt levels may not have decreased as significantly as expected. Furthermore, in 2025, the company made substantial principal payments totaling $641.9 million, while also issuing $650 million in long-term debt. This suggests that the company is actively managing its debt, but it is unclear whether this has resulted in a net decrease or increase in debt levels. The assumption of approximately $261 million in debt as of December 31, 2025, adds to the complexity of understanding the company's overall debt situation. Overall, while there have been some notable changes in the company's debt structure, it is difficult to determine whether these changes have resulted in a significant increase or decrease in debt levels or interest expenses. The performance of various segments and regions has been a concern in recent times. International markets have struggled, with the oil and gas industry being particularly affected. The Persian Gulf region has also seen poor performance, with the Strait of Hormuz and adjacent regional waters experiencing similar issues. Furthermore, foreign regions have not fared well due to preference for local vessels owned by local companies. This trend has had a negative impact on these areas, contributing to their overall poor performance. Management is expressing optimism about the company's outlook, citing its global operating footprint as a key advantage in reacting quickly to changing local market conditions. The company's diversified fleet of vessels serves customers in over 30 countries, with a focus on deepwater operations that are less susceptible to short-term fluctuations in commodity prices. However, management also acknowledges potential risks and challenges, including cyber intrusions and attacks, the adoption of new laws and regulations around artificial intelligence, AI, and the need to balance traditional energy sources with lower-emission solutions. To mitigate these risks, the company is committed to investing in sustainability initiatives and maintaining a strong financial position. Management's growth strategy includes expanding the business and fleet through acquisitions, joint ventures, and other strategic transactions, which will be financed through the sale of securities or debt financing. The company believes it has sufficient liquidity to fund its obligations and meet its liquidity requirements, positioning itself for long-term success in the energy sector. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, one notable deal was the purchase of Wilson Sons Ultratug Participações S.A., and its affiliate Atlantic Offshore Services, SA, for $500 million. Additionally, the company acquired 37 platform supply vessels from Solstad Offshore ASA's subsidiaries for approximately $594.2 million. The company also made a smaller acquisition in the third quarter of 2025, purchasing one bareboat chartered vessel. Furthermore, the company exchanged PEMEX corporate bonds, PEMEX notes, for accounts receivable worth an unspecified amount. On the other hand, the company has also engaged in divestitures. In 2024 and the first half of 2025, the company sold approximately $1 million and $1 million of the PEMEX notes respectively. These transactions indicate that the company is actively managing its assets and liabilities to optimize its financial performance. The company has a history of investing in its shareholders through various means. One notable aspect is that it has not paid dividends to its investors, indicating that the company prefers to retain its earnings for future growth and development. However, the company has actively engaged in share buybacks, demonstrating its commitment to returning value to its shareholders. Over time, a significant number of shares have been repurchased, totaling 4,264,889 as of the last reported period. This strategic move not only boosts shareholder equity, but also signals confidence in the company's future prospects. The total amount spent on these share repurchases is substantial, standing at $215.3 million. This investment in its own stock reflects the company's belief in its long-term potential and its desire to create value for its shareholders through various means. That concludes the financial summary for Tidewater Inc. Feel free to comment below, and I will be happy to answer them when possible.